welcome back to the next video in the Smart Money Concept series. The last video I dropped was on liquidity as a concept, and I spoke about this in an earlier video. I want to drop a single video where we go through things as a concept, and then drop another video where you actually learn how to take that concept, take that knowledge, and then go apply on your charts. Because I firmly believe that if you can understand something properly and essentially like what's happening behind the scenes and what it means, you're going to be able to make more money off of it than purely learning it for the sake of your charts and just being able to profit off of it. But let's get into it. But saying that, make sure you've watched the last video on liquidity. It's not that long, and it will give you insight into what liquidity is and how it works. So I did speak about this in the last video, just touching on it again. Liquidity in the market refers to areas where there's orders, including stops, so as in buy, sell stops, buy, sell limits, stop losses, and take profits. This liquidity can be engineered and manipulated into existence. So I'm going to be speaking a bit about this today. And it's used by bigger players in the market, essentially by, big banks and so forth. They use this liquidity to make their profit. So what is this? What is this concept of liquidity engineering, right? If we come back here, this is called a range, right? This is what most of retail will know a range to look like. Just two levels, support and resistance, bounce, bounce, bounce. Price is just moving. When price is doing this, what are the normal retail traders, what they doing? They're placing orders here, they're placing orders here. It becomes very obvious. The more touches that this gets, the more orders that start residing in these areas. And what's above or below your order usually? Your stop loss, right? Or your liquidation level. So regardless, you're losing money if it is your stop loss or your liquidation. What you need to understand, and it's a very simple concept, but it's just the backbone of this whole thing. In the market, there's buying and selling. For someone to buy something, someone has to be selling it. For someone to sell something, someone has to be buying it. The same way that we buy and sell things to make profit is no different for these roles and bigger players in the market. These market makers, they have to do the exact same thing. They're also buying and selling. But what they're doing is engineering this liquidity. They're manipulating price. I speak about this more in my last video, so go watch that. They're engineering the price to create liquidity. So, these liquidity pools on both sides. So after, what happens is, because they know all these stop losses are here, all these, buy stops, sell stops, whatever, they stay in these areas of liquidity. What they can do is push price into those areas and take that liquidity. They can buy into that liquidity. What's happening here is, let's say our whales, they come, they buy. In this zone, there's stop losses. There's going to be something called buy stops. There's potentially even there's sell limits at this area, but there's people market entering as well, and their stop losses and their liquidation levels will be in this zone, just above that resistance. So if they push price there, and then they can take all this liquidity, it's back to that simple point. Why are they taking this liquidity, right? Of course, to make the money. So there's a few concepts that I'm going to be going through visually. So I've got buy side liquidity, BSL, sell side liquidity, SSL. This is equal highs and equal lows. There's trend lines in liquidity, something called stop hunts and liquidity grabs. I think some people may just refer to them as the same things, and they can be. Before we look into it on the charts and visually, I've been speaking about this already, but liquidity is their profit. These people, these bigger players in the market, they have to engineer this liquidity to gain profit. They have so much money that they're playing with. To get their profit on it, they need to engineer this liquidity to maximize how much they're making. On top of that, it's easy for them. They know what retail traders are thinking. If there's key areas on our charts, key resistances, supports, and a lot of people will react to these areas similarly. They will all place their stop losses in roughly the same zones. Big thing to remember is this is about the majority. I'm not saying everyone will, but enough people are doing it that the whales can come and say, okay, cool, that's the liquidity that we're taking, because that's where they're going to see a lot of profit, or that's where they're going to see the most profit. So they know they can use these key areas to essentially engineer this liquidity, and then afterwards, when they're ready, take it. So let's go back to this. So first thing that we're going to go through is buy side and sell side liquidity. So let's get onto it. Okay, so this is GBP/USD, right? I'm just going to mark out some levels, and then we'll talk about why I've marked them out, right? So let's say there. I'm going to mark out this as well. And okay, let's just stick with these two for now. So we're going to call this BSO. Another thing I always like to include is the time frame with it, because it's going to hold significance and it will give you context. Okay, so it's quite simple, right? Buy side liquidity and sell side liquidity. Of course, this is above and this is below price. So what does this actually mean? Why is this marked out in this way? What's happening is you have here another concept that we are going to be talking about, equal highs, right? What people do, what a lot of traders do, is place their stop losses above this. Imagine we go to our lower time frames and somebody enters a short here. Realistically, their stop loss is going to be up here. They're always going to keep their stop loss up there. But because this is on our daily chart, anyone who's doing, for example, let's say swing trades on like the 4-hour, 2-hour time frames, whatever, a lot of people's stop losses will be inclined to be here. On top of that, you're going to have orders called buy stops, meaning they're going to buy once price breaks this level at this area, because there's two things happening in the market. Just naturally, and I know when I was a new trader, I used to do this as well. I'd think if there's these points of rejection, this is clearly a resistance, right? Price won't break this resistance. If there's a resistance, why is price going to break it? But that's how a lot of retail traders are made to think. That's the context and the information they're given on the internet. And all the whales and these market makers, they know that. They use it to their advantage. So with this buy side liquidity, what you'd expect to happen is for price to essentially push off from here. So for price to come up and take this liquidity. What does taking the liquidity mean? It means that price will wick above this, hit people's stop losses, take that liquidity, and then, do whatever it wants to do next. If we come down, I'm just trying to find an example here. Even use. I just saw one and I managed to use it somehow. Okay. Okay, here. Okay, this is a good example. These two here, of course, they're not equal. I'm going to talk about the importance of equal highs and lows. But here, this would have been our sell side liquidity, right? And what you need to see here is, right, this liquidity under this candle did get taken initially, but then price pushed off. So people entered longs, and what did they do? They put their stop losses below this. So these are daily candles, by the way, yeah. So I'm just trying to give you guys context so you can understand what's actually happening and why we can use this liquidity to our advantage. Price came down. We had some sell side liquidity, purely this first candle, right? Then this liquidity got taken out by the next candle, because this candle pushed below that price. We probably took out some stop losses, took out some sell stops, and of course the whales, they were able to profit. But then price bounced off. So now price is bouncing off. As price started rebounding, people probably started entering longs. So they're entering longs. Where the stop loss going? It's going below this. They're thinking, these retail traders, a lot of even some like amateur traders, they're gonna be thinking, if you put your stop loss here, it's safe. Then comes the next day. Okay, it's a bearish day, and then people may be waiting for price to come down to see what it does, and then they see price bounce. They see price come here and then start moving back up, right? Because of course, even though it was a bearish day, price didn't come all the way down here. Price stayed here and then it bounced back. They would have then also started entering longs. At least a lot of the inexperienced traders, they would have entered longs and they would have thought, okay, price clearly doesn't even want to challenge that zone. Another thing you need to remember, yeah, these areas of buy side and sell side liquidity, if I just change the time frame, a lot of the people are not trading on the daily. They're trading on these lower time frames. So they're not even realizing that these levels on the daily are literally one candle apart. Do you get it? They've got this like essentially closed vision of what they're seeing on the 1 hour, the 15 minute. All they see is this peak under us. They think price can't push below this. And it makes sense. Price starts pushing off. They start buying. They think, okay, bullish, 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 bullish. And then even if you come back to your daily, what happens after? All that liquidity that was manipulated and engineered. So this happening, I'm talking about their actions, as in the retail traders and such, but the the reason that price is pushing off of these key levels is due to price manipulation. Somebody is making this happen. When they're making this happen, these moves essentially force the concept of FOMO onto traders. You saw on the 1 hour how, we came to this bottom, then we just saw green, green, green. Every time there's another green candle, retail traders are thinking, okay, now I need to get in. I need to get in. Price going to keep pushing up. Let me get in. When all these people enter the trades, they stay in these trades and they think, okay, this is the reversal. This is what I meant about their vision is closed in. On the 1 hour, they're seeing 5 bullish candles. On the daily, it was just one bullish candle. And even then, it wasn't a massive candle. We've been bearish, and this candle didn't seem to challenge the next high or anything. Then look what happened. All this liquidity got engineered. The following day, bearish. Just got wiped out. Just got taken out. And essentially what I'm trying to say here is it gets engineered, it's pre-planned, price is forced to move in a certain way, and then the liquidity is taken. When liquidity is taken, these market makers, these roles, they're profiting off of all of these more inexperienced or average traders who are going to be, doing the same thing that a lot of other people are doing. As humans, I feel like people are, this is going to turn to the next point of equal highs and lows. That's what we're going to speak about next, right? So these are equal highs, right? Very clean equal highs. The more equal the highs, the more liquidity that resides above or below them. Even here, very equal. So these are two really good examples. Why? The cleaner these touches are, psychologically, people are seeing this, especially inexperienced traders, and they're seeing such a clean reaction of the same level. They automatically assume that price is not pushing above this. Every time price touches this line, they're going to draw this line in as resistance. They're expecting price to bounce. Over here, they're going to draw out support. They expect price to bounce. What's going to happen is they're going to try enter a trade up or down here. They're going to try to enter from here. They're going to try enter a sell. Their stop loss is going to be somewhere here. What the whales and manipulators will do is push that price, take their stop loss, and then potentially reverse or push up. There's a lot more to it, but the more equal or low the highs, the more liquidity that resides below or above them, because you need to look at it from a psychological perspective. Essentially, you put yourself in the shoes of these retail traders, and then put yourself in the shoes of these whales and market manipulators, and see what they're seeing versus what they're seeing. Do you understand? Because if you can see both perspectives, if you can sit in both chairs, you can know, as a retail trader, this is what I do. Then you map out what a retail trader might do. Then you think of, okay, where is it most profitable for whales to start pushing price? These market manipulators, where will they be making the most money? They're going to be making a lot of money if they take out these equal lows, these equal highs. There's probably a lot of stop losses, buy stops, etc. that sit above or below them, that is just liquidity waiting to be taken by these roles. So back to the presentation. So I didn't go through every concept essentially in depth because a lot of them do just tie into each other. Buy side liquidity I explained, sell side liquidity equal. Sorry, I wrote both as the same thing here. It's meant to be EQHs, equal highs, and equal lows, EQLs. You might see this on people's charts. The reason I wrote SNR is support and resistance. When we have equal highs and equal lows, average retail traders are seeing it as support and resistance. They're not seeing, these equal highs, equal lows, the way we're marking them up. They're seeing it as a point that price will reject. Whereas when I mark it up, for example, I'm seeing it as a point where price should be pushing above that. It should be grabbing the liquidity and then maybe reversing and then changing direction or whatever. Trend lines are also a form of liquidity, the same way support and resistance can be used or be engineered to have liquidity below or above them, so can trend lines. The stop hunts and liquidity grabs is essentially what I've been talking about. When liquidity gets taken out, what that means is price is pushing into these zones, into these equal highs, equal lows, just above them, taking people's stop losses, taking orders out of the market. The market makers and whales, same point again, they end up profiting at the bottom of all of this. They're not moving the market for the sake of it. They're engineering this liquidity. They're doing all of this just so they can make money. The same way we're in this market to make money, so are they. Okay, so just some last points I want to touch on. I hope this video has not been too lengthy. It is a bit to take in, but if you start applying it to your charts, you start seeing the importance of liquidity. You start seeing it get taken out. You're gonna find your liquidity on all time frames. One thing I'd recommend: top-down analysis. Put your liquidity levels, your equal highs, your equal lows, whatever, on your high time frames first, and then of course, you zoom in, you take your setups. It's important to know if you're sitting below a liquidity level or above a liquidity level. Either way, imagine there's equal lows below you that could get taken out on the daily, and you now enter along on the 15-minute. Realistically, if you're managing risk, you should be fine. A lot of new traders don't manage risk, or they keep moving their stop loss, or they risk way too much compared to what they should be risking. And what happens? If they're near those equal highs and lows, they're not paying attention, they're gonna get burnt. Price will literally rip through their order, rip through their stop loss, just take out everything, or even potentially liquidate them completely. So yeah, that in itself falls into this point here, finding confluence for stronger setups. If liquidity's just been taken and now price is showing signs of reversal, it makes sense. You want to look at your different time frames and so forth. Equal highs and equal lows, that's essentially what I just spoke about. You have to be aware of where these levels are. If you don't know where they are, you can easily just get stopped out because you didn't pay attention. If you pay attention to where your liquidity in the market resides, then you know where price wants to go. If you know where the liquidity sits, especially more of it, you know, equal highs, equal lows, especially like I said, the more equal they are, the more liquidity sits there, then you know, not always, but essentially where price is going to be going next. And you can use that to your advantage, not only to make money, but to also avoid setups where you could be risking money. So, it's a win-win situation if you take this into consideration. In reality, all that matters in the market should be, you know, your liquidity, because that's how these market makers, these whales, whoever else, they're making their money. The liquidity is their profit. That is literally the money they're making. So if everyone's in this market to make money, then you definitely need to be learning, about liquidity. Of course, everything I said isn't exhaustive. There's probably more in-depth stuff about all these topics and whatnot. So I hope this video can give you a good, like very good foundational understanding, I hope, of all of like liquidity or liquidity as a concept generally. And you can use this to now start seeing other people's charts, other people's analysis, start looking at other, you know, places of knowledge, books, other videos, whatever to learn from. And if you have that foundational understanding, you can start applying it to your charts, using it. And then when you start seeing it happen actively right in front of you, that's when you realize the importance of, some of these concepts that I've been teaching. But I don't usually put this much, what's the word? This much effort or, pressure into like learning something. But I would definitely recommend that everyone studies liquidity and look into how it works and get a deeper understanding, and then include it into your technical analysis, your setups, and you'll literally see how they level up if you don't include it already. But yeah, that's been me. That's today's video done. Hopefully I'm gonna be back with the next video soon. I'm not really sure what the next thing that I'm planning is at the moment, so I'm open to any suggestions. Anything anyone wants to learn, you can just comment it below. You can message me on all my socials, and hopefully I'll be back very soon.